So with the new tax law that just went into place, a lot of things changed. But one thing that didn't change really for individual investors are the things that you're allowed to deduct on your property for a rental property. So let me tell you about some of the ones you want to make sure you're aware of. Now, first and foremost, we would recommend using a professional accountant if you're investing in real estate. But these are the things that are going to be deductible. Number one, repairs. So every dollar you spend on a repair is going to be deductible against your income on the property to reduce the amount of income you're reporting to the IRS. Now, depending on the type of repair, it may be capitalized, it may be called a capital repair, like a roof. Let's say you had to repair a roof. Well, so you can't write off the whole expense of that roof. That's going to be depreciated over time. That's another reason you want to have an accountant involved on this. But standard normal repairs, fixing things that break, are going to be fully deductible. Secondly is insurance. The money you spend on insurance is fully deductible on your taxes every single year. Your property management expenses. So whatever you pay to a professional property manager, whether it's a management fee, a leasing fee, or anything that they charge to you, that's a deductible expense, meaning that you're actually getting a little bit of a benefit tax-wise on paying that expense to the property management company. Fourth is travel expenses. Now, obviously you've got to be cautious with this. You can't start taking trips around the world and deducting them on your taxes just because you have a rental property in the same state. Watch that trip to Disneyland. But you can deduct a limited amount of travel expenses if it's business related. This again is where you want to bring a professional accountant into the equation. Make sure you're talking with them. But those expenses that you incur, the reasonable expenses you incur by traveling to visit your property, even if it's in another state, are things that you can deduct as an expense against the property. Another deduction are utilities. All the utilities that you spend on the property, whether it's vacant or occupied, are deductible expenses to you. And the last and probably most important is this, depreciation. Now, depreciation is something that the government allows real estate investors to take as a deduction, and this is one of the specific, unique, fun things about real estate, is you can deduct the depreciation on a property. You can depreciate the value of the property itself over time. Now, this again is something you want to have an accountant do for you, but depreciation basically allows this to happen at the end of the year. You can have money in the bank. You've made money on your rental property. You've got money in your hand, in the bank. But yet when you file your taxes, you're filing a loss. It looks as if you have actually lost money on the property. You say, well, how can that be? I've made money. How am I telling the government I lost because of depreciation? The government allows you to depreciate the value of the home over time. Now, when you sell the property, you've got to add back depreciation on the back end. So it gets a little bit convoluted, a little bit tricky. But this is one of the big reasons real estate investors do it. This is why they invest in real estate, because we can make money, but we can still deduct losses on our taxes. Again, use a professional tax accountant. Call us with questions. We'd be happy to recommend a professional to you. But these are just a few of the things you want to talk to your tax preparer about to ensure that you're maximizing the deductions the government allows you to take when investing in real estate.